Good afternoon and welcome to our discussions on the financial statements. In this session, we will try to understand the asset side of the business, the asset side of the balance sheet. One of the important components of the asset side is a cash. So therefore, the focus of our discussion is a cash flow statement. Cash flow statement is one of the important financial statements from an analyst's point of view. And cash flow statement is governed by the International Accounting Standard 7, IAS 7. And as we move along, we'll see more of IAS 7. In simple, cash in hand is equal to the receipts minus payments. But it is not enough to know that the company has excess of receipts over the payment or cash in hand. What is important from a management point of view is where is this cash coming from and where is this cash going to. To do that, to understand that, we have to relate the cash flows to the business decisions, and that's precisely what IAS 7 does. So IAS 7 says that the cash flows of a business may be due to financing decisions, may be due to investment decisions, or may be due to operation decisions. So therefore, it will be cash from financing decision, cash from investment decisions, and cash from operating decision. Let us pick up one by one. Cash from financing decision. The company receives cash because it raises money through equity or through debt. So when a company raises capital, cash flows inward. When company raises debt, cash flows inward. But similarly, there may be outflows due to financing decision, repayment of debts, buyback of capital, payment of interest, and payment of dividend. So the net of receipts from financing over the payment of financing is called cash from financing decision. And CFF, cash from financing, can be positive or can be negative. We'll see that later. What is the relevance of negative CFF? Similarly, cash from investment. Company makes investment decisions by buying the fixed assets of its own company, or maybe investing in other companies, buying shares of other companies, buying bonds of other companies, so maybe in making investment. In the same way, the company may be selling its fixed assets, maybe selling its shares of other company, selling the bonds of other company. So the receipts due to investment decisions minus the payments from investment decisions will be called cash from investment decision. One of the important items in investment decisions inflows is a dividend received and interest received. So CFI can also be therefore positive CFI and a negative CFI. The negative CFI is very important to now understand. Negative CFI by default is not a problem, because that means a company is creating investments, creating assets which has the potential to generate future cash flows. Now let's see CFO. Cash from operation shows the cash generated by the business from its main activity. What is that? It's a cash inflows due to operation, sale of goods and collection, and cash outflows due to operation, expenses paid, suppliers, payment to the supplier will give you cash from operation. But an important point here, that one has to get into the detail of understanding the difference between cash from operation and the profit, because the profit may be there, you may not have cash from operation, or there is a possibility that you may be having a huge negative profit but a huge positive CFO, or vice versa. So there is a need to understand the link between, the relationship between the profit and CFO. What is IAS 7 saying? IAS 7 says that CFO can be determined through a direct method, where you just find receipts from operation minus the payments from operation, or you can find CFO from an indirect method, where you try to reconcile profit with CFO. So that means you make an adjustment to CFO and the profit. So that means CFS, as per IAS, every company is bound to show CFS, divide the CF cash flows into financing cash flows, investment cash flows and operating cash flows, and operating cash flows can be determined either through a direct method or an indirect method. Both have its strengths and weaknesses. But from an analyst point of view, it's useful to understand why is a profit not same as CFO, or why is the company making profit, no cash flows. So CFO becomes a very important tool for understanding the profitability, the liquidity of a company. And as we move along in the next sessions, we will try to see what are the actual cash flows from various companies. Is the cash flows a function of the nature of the business? Is the cash flows a function of the risk-taking ability, or cash flows function of the major economic condition in which the companies operate? Thank you very much.